Okay, well, thank you very much, George. Nice to be presenting to you all. I have to admit, this is my first Zoom investment conference, so it feels nice to be presenting to you all from the comfort of my sweatpants. No, I'm kidding. I'm fully dressed in formal attire, and I'm ready to go. I have a lot of slides here. They're detailed, really, so that you guys can get as much detail as you can. I'm going to maybe skim through some or summarize some for the sake of time. We hear a lot of increasingly growth investors, value investors even, talking about a rate of return, ROIC, incremental ROIC, things of that nature, compounders. They've literally turned compound a verb into a noun now. So let's look at that from kind of a value lens and see what kind of thoughts we can come up with. So I guess the first question, there are many types of rates of return. So which rate of return are you referring to? We usually associate it with the rate of return of the underlying business or asset. Could be a real estate property, for example. In the case of business, it would be the incremental ROE or ROIC of the business. There's the rate of return on the purchase price of the business. This could be the forward free cash flow yield on a stock, the cap rate on a property. It's one way of expressing valuation. And I'm also going to refer to it as the initial return. And you have the rate of return on your investment in the business. For example, the annualized total return until you sell your shares. Let's look at that last one, the investment rate of return. So to get the investment rate of return using this framework, we would need the rate of return of the underlying business and the amount of capital that can be invested at those returns. So the amount of equity capital that can be invested at the incremental ROE, or the amount of total capital that can be invested at the incremental ROIC. Together, this would form the growth rate of the business. Then we would need the rate of return on your purchase price. That is the initial return that we alluded to earlier. And when you combine those, that kind of gives you the IRR in perpetuity, over the life of the business. Now, over a holding period, we would also need to account for changes in the free cash flow yield between the time you buy and the time you sell. So, and since the inverse of the yield is the multiple, I'll just, for simplicity, refer to this by the familiar terms multiple expansion or multiple contraction. And so when you take the initial rate at which I've invested and then the growth of those cash flows, and any changes in my upfront return from the time I buy to the time I sell, so multiple contraction or expansion, that gives you the investment rate of return, or IRR, over your holding period. Now, I kind of touched on this at first, but investors usually think about ROE or ROIC, incremental ROE or ROIC if we want to be more technical, when they are talking about rate of return. Yet in isolation, these metrics don't offer you that much information about the business, or at least they're lacking. First of all, how much equity or total capital can be reinvested into the business at those incremental ROEs or ROICs? So, for example, it does little good to be a very high return business if, for example, you're over leveraged and you have to use all of your cash flow to pay down debt with a 3% interest rate or something like that. Or if you're just a business that doesn't require a lot of capital. And that leads us to the next question. What about other avenues besides the business into which management could deploy free cash flow and any new equity or debt capital that they raise? So this would include debt repayment, dividends, buybacks, things like that. Diversification into new businesses. To the extent management does that, that radically alters the return and growth profile of the business. And just looking in isolation at ROE or ROIC does not account for that. By the way, it could also work on the flip side. You can have very low return business that a skilled management could redeploy its cash flow into very high return endeavors too. And then if we go beyond the business return, rate of return, to the most important factor, which is the rate of return on your investment, the ROE or ROIC, in other words, what I'm calling the business rate of return, is also uninformative if you don't also consider the initial return based on your purchase price. In other words, the valuation. So the initial return, that's the base off of which growth compounds. It doesn't tell me anything to know this thing has a 40% incremental ROIC and can deploy a lot of capital and it can grow at XYZ. Is that growth coming off of a starting point of 1%? If I pay $100 for $1 of earnings, or I pay $100 for $20 of earnings, that changes the picture in terms of what that in business growth compounds off of. The initial return also determines the odds of multiple expansion or contraction, which over a given holding period often is the dominant driver of returns. So I guess this is one framework and one way of articulating that in today's market that is obsessed with growth and has been for so long. We think about rates of returns on businesses or assets, but we often forget that for the rate of return that matters most, the rate of return on your actual investment, the initial return, i.e. the valuation, is every bit as integral as the returns of the business. So I want to take a look at a couple of case studies where we look at value investments from this framework or from the perspective of return. And the first one I want to talk about is called Terabest Industries. I'm calling it the complete package because you have a high initial return on a high return business. If you saw my presentation talk at the Ivey School a couple of years ago, I also summarized Terabest. It's been a favorite of mine for a long time. It's my largest position. It trades around $17. It has a market cap of about $320 million. All these figures, by the way, are in Canadian dollars for both Terabest and the other security I'll be talking about, since they are Canadian stocks. Just quick background on Terabest. It is a Canadian consolidator of niche manufacturing businesses. Currently, it's a dominant producer in its current markets. Propane, ammonia, and NGL transport vehicles and storage vessels, heating oil tanks, wellhead processing equipment, and those kind of give it a very stable cash flow and low capital requirements, and it uses that cash flow to redeploy into additional markets, and there are numerous such markets that we'll touch on later. The secret sauce here is the company focuses on small industries where there's little competition for deals. The owners are often unsophisticated, typically retiring or in distress, and Terabest is the only natural buyer, and they can realize significant synergies following the acquisition and pay a good going-in price to begin with. Let's look at Terabest's initial return, the estimated forward free cash flow yield. I take EBITDA, by the way. For those of you well-versed in accounting, I have adjusted reported EBITDA for IFRS 16. So I reduce EBITDA by what used to be the rent expense. And I also exclude interest on capitalized operating leases from interest expense. Just a little kind of accounting note. So if you take all those, you get a forward estimated free cash flow of about $35 million or $1.88 a share, which gives us a free cash flow yield of over 11%. Over 11%, an 11% initial return for a business that can compound capital at significant rates for the foreseeable future. I think that's pretty uncommon, especially in today's richly valued markets. I'm going to leave you guys to read up on this in detail later on, and just some detail regarding the various puts and takes on EBITDA and why we can feel comfortable that our estimates are reliable. Bottom line, they are. I'd highlight in particular that they have certain divisions that serve Western Canada, which are dramatically under-earning. Conditions there are at historic lows. Now let's look at the underlying business return side of the equation. First, let's look at pre-tax ROIC, return on invested capital. And I'm taking the average instead of the current quarter invested capital because there's some seasonality in working capital for this business. But bottom line, if we do that and we take forward EBIT, I'm using maintenance CapEx for EBIT instead of depreciation. You have a pre-tax ROIC of 27%. I think that's very attractive for a business that can deploy, as we'll see in a moment, significant capital at these rates. How about return on equity? We are, after all, equity investors. Terabest has a pretty, they have a conservative leverage relative to the stability of their cash flows and their working capital levels. They have a high working capital that's inherently leverageable. On a return of equity basis, 35%, again, is, I think, very solid, a very strong ROE, especially if it can be sustained for a while. So how has the company managed to generate these returns on investment? Well, the secret sauce here is, as I noted earlier, the acquisitions. So let's take a look at all of the acquisitions they've done since 2013. So this would be since they embarked on their current consolidation strategy. They've spent about $110 million. They've also incurred growth CapEx of $11 million subsequent to the acquisition. I think that's relevant too, because if we're looking at the total investment in acquisitions, we need to also take into account the subsequent growth capital that's been invested. And that will give us about $120 million that they've spent over that time. If we then assume a certain proportion of debt financing at 2 times debt to EBITDA, so of that amount, how much was can we say was financed by debt? About $70 million, leaves us with about a $50 million equity investment. And then right below that, we estimate the free cash flow that they are earning on those acquisitions today of $23 million, excuse me. What does that leave us with? Well, for every acquisition Terabest has done, they've averaged a deal a year for 8 years. That gives us a 2.3 times cumulative multiple on cumulative acquisition capital spending, or a 44% after-tax return on investment. An excellent record on acquisitions. That's why they've generated the ROICs and the ROEs that they have. Now, it's all well and good to have a good record and to have generated strong returns in the past. Can they sustain it? I believe they can, due to a combination of their record, which we just touched on, which is exceptional. Also, the relative youth of management. The executive chairman is 45. The CEO is just 37. They can keep it up for a long time. And then lastly, they're just going after large markets. So it means they can deploy a lot of capital. Again, as we said earlier, it's not just about your returns. It's also about how much capital can you invest at those returns. And so let's look at some of those avenues for future investment. They can do continued consolidation of the propane and ammonia tanks and trailer market, which they're already strong in, but it's fragmented market with lots of opportunities. They can get into furnaces and boilers, liquefied natural gas and compressed natural gas tanks and trailers. LNG is a growing market, particularly in North America. They can get into green energy, hydrogen tanks, renewable natural gas, RNG. They can get into that via RNG processing equipment. Can you imagine if one day Terabest is thought of as having a large and growing presence in the renewable energy market? I think it would radically alter their perceived return, their multiples or free cash flow yield. And I have every reason to believe that they will tackle those because they are adjacent to the markets they're currently in. There's other markets as well: chemical tanks, septic tanks, air filtration equipment, et cetera, et cetera. And the more markets they enter, the more additional new markets open up as a result. And they have a history of doing that. So like their tanks division basically just started off making heating oil tanks, residential heating oil tanks. And now they've expanded to doing so much more. Lastly, also opportunistic repurchases. So large markets being targeted, great record, and the management age and the number of years I believe they have left to continue to build this company mean that the strong business ROR should be sustainable for many years to come. I touched on buybacks. I want to just quickly demonstrate that their record on that front. So in 2012, they bought back over a third of the company at $275. Stock has sextupled since then, paid nearly $4 in dividends relative to the 150%, almost more than the amount they paid for that tender. And they have had other instances where they bought large amounts of stock at very attractive valuations. So they're very shrewd on that as well. And that adds another quiver to the arrow, so to speak, in terms of avenues for capital deployment at high returns. Now, let's say, let's take a look at an illustrative IRR over the life of a business. So we talked about how the investment rate of return, or IRR, is a function of business growth, which is dependent on the business's incremental return, ROE or ROIC, the amount of capital that can be deployed, what happens to the capital that can't or is deployed elsewhere, and your initial return, the valuation. And lastly, multiple expansion. Now let's take multiple expansion out of the equation and just say this investment is held in perpetuity. What kind of IRR are we looking at? So with an initial return of 11%, you'll notice that even with assumptions that I've attempted to demonstrate, and I strongly believe are fairly conservative in terms of future growth. So you could have 15% for 5 years, 10% for 5 years after that, and 2% terminal growth beyond that. Again, I think they can sustain their growth for much longer than that. But you still get a 21% IRR over the life of the business, which is quite strong. And again, this is illustrative. In reality, they can get multiple expansion, and I believe that they will. You're not going to hold this for the next infinity years, and at some point, multiple expansion or contraction will occur. And let's see a more realistic scenario where we take that into account, because I really don't think the multiple will stay at 9 times or the initial return at the 11% free cash flow yield forever. Let's say in 2 years, you're looking at forward free cash flow of $44 million. Here, I'm assuming 12% annual free cash flow growth, 3% annual reduction in shares outstanding, consistent with their historical pattern of repurchases, and a continuation of their current dividend. I know that 12% annual free cash flow growth is something I think that they can exceed over time, at least in the foreseeable future. Then we apply a multiple of 12. I think pretty fair, maybe even conservative, again, in today's market. And you get an equity value of $530 million. You divide it by the shares outstanding and add 2 years of dividends. You have a total return of 80% and an IRR of 35%. Pretty compelling. How about let's take a look at a bit of a longer time frame. Let's say 5 years. So the longer Terabest can demonstrate the attractiveness of its capital allocation model over the long term, the more it's likely to benefit from additional multiple contraction. Once they've been making this work, it's been 8 years. Once they can do it for 12, 15 years and continue to show that their secret sauce is working, they should be recognized for that. So if we then continue our prior growth assumptions, now we apply a multiple of 14, again, hardly a Herculean multiple. We get a stock price of $54, add the dividends, and we have a 230% total return and a 28% investment IRR. Now, since this is a value conference, we're all value investors at heart. I want to take a look at another example. Just pure value. The initial return is so attractive that it just dominates the whole investment IRR equation, and that is a TVA Group. Trades at about $225. market cap of 100 million. It is a Quebec broadcaster with network TV and cable and satellite channels. It has a 40% share of French language audiences in the province of Quebec. Beyond broadcasting, it's reinvesting those cash flows into content production and distribution businesses. And lastly, it has a small and profitable but declining magazine business. So it's kind of a hodgepodge, which combined with its small size is why it's what you're about to see. Here is the initial return, that i.e. the free cash flow yield. And here I'm just using actual 2020 results. If we just took the just completed 2020 figures, what would we have? Just look at the bottom there. 1.9 times free cash flow for a 53% free cash flow yield. That is phenomenal. And clearly I don't have to elaborate on why that's compelling. Now, not so fast. Let's see if we can get some further confidence in the free cash flow yield. And here's where we have to look beyond the numbers, parse the numbers, scrutinize the numbers. They actually benefited from a material accounting item in 2020. So they broadcast NHL games in French in the province of Quebec, and they pay sizably for the rights to broadcast those games. Those payments are not expensed. Instead, they're capitalized and amortized to operating expenses as the programming is aired, as the games are aired. Because of COVID, the start of the 2020/2021 NHL season was postponed. It was supposed to start in Q4 of 2020. It got pushed to Q1 of 2021. And because of that, TVA could not begin amortizing the broadcast rights payments in 2020, and that significantly inflated EBITDA. Even though it's technically an amortization, it is included in EBITDA. As a result, obviously inflated free cash flow as well. There's other items related to COVID. But bottom line, let's adjust for all that by using 2019 EBITDA instead of 2020, which didn't benefit from that one-time item, was much lower. And in fact, let's be even more conservative and apply a hefty discount to 2019 EBITDA as well. And here's what here I've done that. Now, what is our initial kind of purchase price rate of return based on what I've just outlined? So I'm going to take 2019 EBITDA, 68 million, apply a further 20% discount. We're left with 55 million versus over 80 million that they actually generated in 2020. Subtract maintenance, capex, interest, and taxes, and we're left with a free cash flow per share of 75 cents. So even after these adjustments, we have a 33% free cash flow yield. So any way you slice it, the free cash flow yield is astronomical. Yeah, you almost never see valuations like that unless there's an entire market meltdown, the company's in financial distress. Far from being in distress, TVA actually has almost no debt. And again, because we're value investors, I can also throw out that it trades at just 35% of tangible equity as well. So can we get confidence in TVA's growth? Now, the business ROR side of the equation. Well, we don't actually have to, because it doesn't have to grow for us to do fabulously well. As an aside, TVA actually has managed to grow EBITDA and free cash flow in recent years by using the strategy I outlined earlier of redeploying its abundant broadcasting cash flow and taking advantage of its strong balance sheet to execute acquisitions. Now, if it can just keep free cash flow stable, investors would have an outstanding outcome. What about if it can't? In the absence of further acquisitions, I still think you do quite well because, yes, the business would go into decline. But let's not forget all the interim free cash flow that's being thrown off during that period. The interim cash flow, free cash flow that will be generated just in the next few years alone is going to be so large relative to the market cap that investors would still be very handsomely rewarded. We can also look at this from the perspective of risk and margin of safety. With a 33% initial return, 33% forward free cash flow yield, almost debt-free balance sheet, there's very little that can hurt the investor in this equation. Now, not only does TVA not actually need to grow, it can actually shrink and we'd still do quite well. That is is how prodigious its current cash flow is relative to our purchase price. So I'm doing here the same calculation I did for Terabest, but instead of assuming growth, I'm actually assuming contraction. So we take the forward free cash flow as our year one initial return. We then compound that at minus 5% for the first 5 years, minus 10% for the next 5 years, and then minus 15% terminally beyond that. We still have an investment IRR in the high 20s. So TVA is going to, the takeaway here is that although it's a deep value investment, clearly, even from the framework of IRR, rate of return, if we think about it holistically, it's clearly positioned for a great return. What's the fair value today? Who knows? I'm just trying to be here simplistic and conservative. I'm using a multiple of 6 times. If they can maintain or even grow EBITDA and cash flow in the next few years, and again, they don't have to maintain their very high EBITDA from last year. They just have to maintain the conservative EBITDA that I've used, which is around 30% lower. So it's not difficult to imagine a multiple that's higher than 6, of course. But I'm just trying to show that really with conservative assumptions all across the board, you still have a stock that's worth double today's price. I want to wrap up just very quickly with tying all this together. And my initial comments tying that together and looking at a common IRR fallacy. And this comes from that inattention to the initial return and changes therein, changes in that purchase price return as drivers of ROR and the flawed thinking that can result in. You may have seen this before. I've seen many statements like this. And here's an example. We expect ABC to compound free cash flow per share at 18% per annum over the next 8 years. Shares of ABC trade at 25 times, which is a reasonable multiple for a company that can grow at these rates. Therefore, assuming no change in multiple, investors in ABC can achieve a compelling 18% IRR over 8 years. What is this rationale missing? Well, in reality, stocks discount the future, and the purchase price return will increase. In other words, the multiple will drop as growth slows. Nothing grows to the sky. Nothing grows indefinitely. And that will cause a divergence between the investor's IRR and the business IRR and growth rate. And, for example, in this case, if the initial multiple of 25 times drops to 15 times, because again, we've now entered a lower growth phase after years and years of rapid growth, multiple contraction has effectively halved your IRR. And of course, as we know, especially nowadays, if a business that can grow at those rates for that long won't trade at 25 times, it might trade at 40 times. And when growth slows, it might slow much faster, and it might not just slow, but go to zero. And there's no margin of safety in that. And all this confirms what we already know as value investors: price matters. And I'll leave it at that. And looking forward to the panel. Thanks, George.